All right, what's going on, man? We about to be talking about what is an ETF, right? So, to know what the ETF is, we gotta know, the different investment types we have when it comes to actually, ETF investing or just investing in general. So you have your general stocks, right? Which is the single building block represents direct ownership in a specific company. So a stock basically is when you invest to a single company, which would be like, Apple, Microsoft, Tesla. You would be owning that only that one company, right? But a mutual fund is something different. So the mutual fund is a basket of investments, right? So usually like a basket of stocks, for example, but it'll be professionally managed, meaning it'll be managed by these top hedge funds like these Black Rocks, these Vanguards, or even like these private hedge funds, right? Which are like people that basically take investments from a bunch of different people and then they manage the money to grow it to the best of what they believe the ability is, right? So, but it's professionally managed. And ETF is kind of like the investor type is more like a stock, but it's still a basket of stocks, but it's not professionally managed. It's just managed by algorithms and bots, etc. Right? More than likely artificial intelligence at this point. But yes, as a liquid low cost hybrid that holds hundreds of assets but trades like a single stock. So you'll be trading it just like you'll be trading a single stock, but it's a basket of stocks instead, which makes it a stock but better because you have the diversification, which means it lowers your risk. But depending on what you want to get into, it can maximize your return as well. So it's the best of both worlds. Okay, so for example, the trading speed. You can enter stocks and ETFs anytime within a day, but mutual funds you can only enter at the end of the day. The pricing is the market price. So whatever the price of that stock is at that very moment is what you'll be getting in. The same with the ETF, but the mutual fund is different because you only are able to enter at the end of the day. So it'll be based off that net asset value, right? The minimum investment is going to be one share price. So again, whatever the cost of that share is, you'll be getting in. Whereas a mutual fund, you have to invest a certain amount of money into that, and then they'll grow it. So it's differently when you get into mutual funds, you're not actually trading the price. You're trading what the actual hedge funds have the value as. So the hedge fund's goal is to grow the actual value of the entire mutual fund, and you'll get paid based off the equity of that. It's almost like owning a real company in a sense, like you're owning the actual company itself, almost in a sense, right? Diversification. So in stocks, you're getting into that single asset, right? So you're only getting into Apple. Whereas in mutual funds and ETFs, you're going to be getting into the actual basket of multiple companies or whatever they're putting into that basket. And a tax efficiency. So in stocks, you have high tax efficiency because you control when you can get in it and get out. So you can, utilize the short term investing rule and then the long term investing rule. So that'd be helpful. The mutual funds is low because they constantly trade in and out of stuff, right? So you'll have a little bit not as good taxation on that. And then the ETFs is basically kind of the same as the stocks. You can get in and get out when you want to. And then the expense ratio benchmark, right? So usually ETFs are better because they have lower expense ratio, which means basically this is the amount you have to pay of your portfolio, basically depending on like basically paying them for managing it, right? So ETFs are going to be your lower fees because you're paying less to manage it because they're just managing with algorithms. Whereas passive mutual funds, their benchmark is slower on when they get in and out of trades. And active mutual fund, they're getting in and out of trades more often, so they're managing it more, which means they want to charge more. But usually, this plays a big role in how much money you actually make because this 0.14% plus, to this 1%, this 1% is 14. If you really look at it, what 10 times? This is 10 times. So you're paying 10 times more for them to actively manage your mutual fund, right? So if you're paying them 10 times more, the return alone can be made in these fees. So that's why ETFs are pretty much the best because not only is it like a single stock, but it puts everything into a basket, meaning that you have better diversification, lower risk, maximize returns because they automatically take the worst stocks out and put the better stocks in, right? So that's that. You can get in and out of it like it is a stock. You have good control over your taxation and stuff like that, and you have the lower fees. So that's why we're going with ETFs over mutual funds. And if you don't want to take the risk of a single stock, then that's why you'll go ETF.